I'm with Trevor Greetham, Director of Asset Allocation at Fidelity International. Well, Trevor manages around $11 billion in assets overall. Fidelity International has almost $200 billion in assets under management. Thank you so much for coming on the show. Trevor,
morning.
We spoke a couple of months ago, and I remember it was really at the height, what we thought, at least what I thought was the height of the European crisis. Now we have this added, conundrum of what's happening in the United States. Are you very nervous about what's going on? We have to deal with the possible recession. Mr. Feldstein they're saying it's a 50-50 chance that the U.S. does fall back.
Yeah, I think we've got to get used to the fact that the big developed economies have a very slow trend growth rate at the moment. And if you have a slow trend growth rate and you have a normal business cycle, you dip into negative territory more frequently. So you go back 200 years, and the average business cycle, recession to recession, is 5 years. Well, maybe we're just seeing a below average one. Maybe 3 years is below average and not that surprising. So I think there is risk that we're dipping back into recession. Certainly in the UK it feels like it. And I think there's risk elsewhere as well. And I think we'll get policy stimulus, but the question is when. So
you're expecting quantitative easing in the US in the next, that's the million-dollar question, when?
Well, I think next week is too soon. Jackson Hole later this month is possible, we'll get a hint then. But inflation is a lot higher. Inflation is about 1.5% at the core level in the US. It's annualizing, if you look at the quarterly rate of inflation, at 3%. So I think to get the Fed to move, the markets have to drop a lot. So we need stocks down and commodities down for the Fed to move soon. And if they don't fall very much, the Fed won't move and we won't get the stimulus.
And so what does it actually mean for equity buying? Because you favor US equities, I presume, on the back of, buy when they're low, and then if the Fed comes in and puts extra stimulus, and they'll go up again.
Well, the first thing is we run multi-asset funds. So the fund I manage, the multi-asset strategic fund, we're overweight now in bonds, US bonds particularly. We like gold. We've got quite a defensive flavour to things. But within equities, we're overweight the US and the UK, because we see this as the QE economies. And what will happen is you'll get QE at some point, which will probably devalue those currencies. But for domestic stocks, it's good news. So we have this strategy where we were overweight the US and the UK stock markets, but we're underweight the dollar and we're underweight sterling.
But Trevor, when would you exactly be buying these US equities? Because what happens if you buy the equities, but then we don't get QE?
I'm not in a hurry to fish for the bottom here. So if we see a big correction, it makes it more likely we get QE soon. The Fed doesn't want to do it. The ECB never wants to do it. And we may get on to Europe in a second. But unless there's a really big market crisis, the central banks won't move. So it's more a question of distance than time. There's a big drop in stocks.
But so are you actually expecting this big drop in stocks? Are we talking 10%? And is this going to be, you talk about this big movement that will force the central banks to come in.
I think it would have to be 10% off the S&P. If you think about last year, when QE2 was announced, it was after a 16% peak-to-trough move in the S&P. Before last night, we'd had 6%. So we've been trading in this sort of narrow range, but we haven't yet sort of scared the policymakers. And I don't know if the markets are actually out there to kind of short and then buy back. It's just that there'll be a buyer's strike for a while, I think. So there's downside risk. And then the policymakers may step in.
And on the Bank of England, you're also expecting them to either buy more bonds or do some kind of quantitative easing here as well. And that's why you would favor UK bonds compared to periphery Europe.
Certainly. We like UK gilts, we like US Treasuries, we've favoured the core Eurozone bonds as a safe haven. The UK is a kind of interesting case because the IMF is now backing away from their own advice. A year ago, the IMF was saying, well done, Britain, you've got the austerity programme. And now they're saying, well, you might want to sort of dial it down a little bit. And what worries me a little bit about America is we now have this debt agreement where there's talk of austerity. And it's not front-loaded, it's back-loaded. But we know what they did to consumer confidence in the UK and in Eurozone countries. And I think we need some more Keynesian policy. I think, by all means, print the money, but spend the money as well. The government needs to spend the money. And that's just way from the consensus view.
You have been buying also the Swiss franc. Now we're talking about possible intervention, and they've actually cleared out or laid out exactly what they'll do. Will you stay away from it?
We don't have a big position there. I mean, most currency models look at valuation, and it is massively overvalued. And they look at the interest rate carry, and there is no interest rate. So it's really only momentum of the three main factors that people trade off that's been in the Swiss franc's favour. So we're sort of mildly overweight Swiss franc. We're mildly overweight the yen, which has very similar characteristics. And these are both the sort of safe haven currencies. You've also got out there the euro, the Aussie and the Canadian, which are the carry currencies, which tend to do better when the world economy is strengthening. And I think those are being questioned a bit as well. Meanwhile, you've got the sterling and the dollar, which are the QE currencies, and they're going to print more money. So the main thing we have is we're underweight sterling and the dollar, and we're sort of hedging our bets a bit between things like the Aussie and the Swiss franc.
What about gold? Because we're seeing, I think we saw another record actually this morning. Is it now in asset bubble territory?
Gold will keep going up while real interest rates are so low. And you can now look at the TIPS market, or you can look at the gilts market, and you pay the government to protect you from inflation. It's not about lending the money anymore. They're not charging you an interest rate. You pay them. Rather, you pay them to look after your money. So I think as long as you're seeing things like negative TIPS yields.
So do you actually, are you buying any gold?
Yeah, well, the multi-asset funds have got commodities in them as part of the benchmark, and we have an explicit overweight in gold.
The UK is a little bit of an unknown at the moment, because we're seeing quite a lot of pressure still on the government to actually cut the deficit, and yet gilts are considered safe haven.
Yeah, you don't want to listen too much to bond investors if you're a government, because bond investors love death, destruction and deflation. You know, if you're holding gilts, you want to have a weak economy with sort of low inflation. And I do think some of the advice that the UK government's being given is very deflationary advice. And I think there's a great pressure on them to reverse course on that. And we'll see what happens in the next few quarters. If growth remains as weak as it is, if they don't ease fiscal policy, there'll have to be a big wave of monetary ease again, more QE, and possibly targeted QE through a national bank or something like that. Maybe a new Fannie Mae, Freddie Mac structure. That'd be good.
Let's hope not, huh? What about Trevor?
It was a serious point, because it came into force after the Depression to help housing, and that's probably what the UK needs at some point.
You think, but what, in the next 12 months?
No.
Afterwards?
It might take longer.
All right, Trevor, we'll get you back in and get more on that. Trevor Greetham, thank you so much.